there, FedEx employees. Thank you so much for watching. My name is Samantha, and I'm in client services here at the Retirement Group. I moderate these weekly webinars for you. In just a minute, we're going to be joined by one of our senior advisors here. His name is Wesley Boudreaux, and he's going to be talking about some of the Hello there, FedEx employees. Thank you for watching. My name is Samantha, and I am in client services here at the Retirement Group. I moderate these weekly webinars for you. In just a minute, we're going to be joined by one of our senior advisors here. His name is Wesley Boudreaux, and he's going to be discussing some of the IRA tax strategies that you should consider. But before I bring Wesley out, I would like to very quickly remind you that although we work very closely with both active and retired clients of FedEx, the Retirement Group is not affiliated nor endorsed whatsoever by FedEx. We are a completely independent group of financial advisors here. Please keep that in mind as you listen along today. After Wesley's presentation, I will rejoin him again very quickly to ask him some of the questions that were entered into the Q&A chat throughout his presentation. We try our best to answer as many as we can, time permitted, of course. And lastly, throughout this video, you may see some YouTube cards popping up on your screen. Feel free to take advantage of those. They will guide you to several different resources, one or two of which being the complimentary cash flow analysis, where you can book an appointment with an advisor to get started on your retirement planning, as well as a link to just book an appointment with someone like Wesley to talk to him directly about any specific concern or situation that you have. Please take advantage of those. And now, now that I've gotten all of that stuff out of the way, let's bring on our speaker today, Wesley Boudreaux. Hey, Wesley.
Hey, Samantha. Thank you. Appreciate for that introduction. Like she said, we are going to be going over some different tax issues that we come across with clients and prospects, but primarily we're going to talk about some different IRA strategies that can be beneficial to you both pre-retirement and post-retirement when we're likely to work with you on a more one-on-one basis. But let's get into some tax changes. We have the Secure Act come out 2020, then Secure 2.0 in 2022. And so there's a couple different changes that kind of came through, some good, some bad. We'll talk about the required minimum distribution changes, stretch IRA changes. We'll also go into some tax brackets, the updates for 2024, and talk about the different state taxes, how that affects you in retirement, and then we'll get into some different examples as well. But first and foremost, one of the best things that did change with both the Secure Act and then Secure 2.0 was the change of the RMDs. So again, an RMD is required minimum distribution, which essentially is a point in time where the IRS comes knocking on the door and says, hey, we've let you defer this money for a long time in your 401k or your IRA, and now we want to start making you pay taxes on it. So you have to start taking a distribution. There's actually a divisor factor that you use to calculate that out, but roughly it comes out to a little bit under 4% a year at the beginning, and then starts to grow gradually from there. But it used to be 70.5 when you were forced to start taking distributions. They then bumped it up to 72, and then now they're actually bumping it to 73. So again, in this case, if you were born between 1951 and then 1959, at 73 is when you're going to have to be forced to start taking your RMD. They still have the option where you can defer it the first year until April of the following year. But if you do that, you're going to have to double dip and take 2 distributions the following year. So again, there is still some tax planning strategies there, but it's important to kind of understand those. And then for those of us who are younger, if you're born after 1960, it's going to be even farther out. It's going to be 75 that you don't have to take your RMD. So one of the best benefits with this is it just extends the amount of time that you're able to defer your taxes. But that doesn't necessarily mean that you want to do that, because a lot of the clients we work with have larger IRAs because they had good 401ks. They may have had pensions they roll over as well. So if we just continue to not taking distributions and deferring that out, come 73, come 75, you might have a pretty big tax bill because you're gonna be forced to take out a large amount. So the benefit of stretching this out farther gives us more planning time frame for Roth conversions, things like that. We'll kind of touch on a little bit later in this webinar, but to be honest with you, most of that's a good one-on-one conversation to see where it fits you specifically. Now to the bad, one of the bad things they did was they actually did change the stretch IRA issues or benefits. It used to be that if you passed away in an IRA, there's not a 401k, but an IRA, and you left the money to a non-spouse beneficiary, let's say your kids, for instance, which is typically the largest majority of situations like this, they were able to actually stretch out the distributions over their lifetime. So let's say you leave something to your son who's 50 years old. They're able to take out a little bit each year to minimize their taxes. Now that's been changed where they have a 10-year rule where it has to come out within the next 10 years. So they can take it out 1/10 at a time if you want, or all at once. But essentially, it has to come out within 10 years. So what that means, it could be a bigger tax hit to them, especially we hope that when we pass away, our kids are in their 50s, maybe 60s or so. But if they're in their 50s and they're still working, they might be in their higher income years. And now on top of that, they've got to take a distribution from your IRA. They inherit it, so it could be bump them into an even higher tax bracket, which in turn could generate more income for the IRS, which is probably one of the reasons for this. Spouse beneficiaries, no changes there. You can still that will still go to your spouse. He or she can actually go ahead and just move that over to their own IRA and continue to take that out on their own schedule. But if you were taking RMDs already, so if you're over 73 or over 70.5, if you were taking them before, then they do have to at least continue making those options. Another change, a beneficial change, was the addition or the removal of the rule saying you cannot make contributions after RMD age. It used to be at 70.5, you had to take your RMD. You also couldn't make any contributions to an IRA. So let's say that somebody retires and goes back and maybe works at a hardware store or Walmart or somewhere, or does something just for some part-time enjoyment and wants to put that money away in an IRA. They can still do that, whether you're 70.5 or whether you're 80 or whether you're 90. If you're still working and want to put money into an IRA, you can still do that as well. So that's actually a good benefit there we have. And jumping into the taxes, the tax brackets have not changed. They're still the same here. We'll see what they do for adjustments in 2025 when those tax brackets sunset. We'll see if they keep them or if they bring them back to the old brackets or do something differently. But be rest assured, we'll give you an update on that once we get it. But let me kind of zoom in here a little bit because this is kind of a busy slide. But just to give you kind of a breakdown, again, there's the 10, 12, 22, 24, 32, 35, and 37% bracket. Let's take a look at, for an example, in that second column for married filing joint. Let's look at that 12% tax bracket. So that goes from 23,200 up to 94,300, and then the standard deductions are almost about 30,000 there. So what that means now is, let's say if we're working with a married couple and they're retired, they've got just shy of about $127,000 that they can pull in before jumping from that 12% to the 22% tax bracket. So a pretty big jump, 10% jump. That gets into an example of those Roth conversion strategies we talked about before. So let's say that I'm gonna round the numbers, make it easier. Let's just say 130,000 is kind of the cap of the 12% when you factor in the standard deduction and the normal tax bracket. It's a little bit shy of that. But let's say that somebody only needs $70,000 to live off of. That means they theoretically could take out another close to $50,000 or so and only pay 12% taxes on that. And I would argue that 12% is a pretty favorable tax treatment. Chances are those tax brackets may go higher down the road. And then also, if they are not taking out too much, if they've got a good sizable amount in their IRA or 401k, that could be growing and they could be forced to take out more later when they hit that RMD age. So it may be beneficial for this specific couple to, let's say, take 40 or 20 or 30 or 40, maybe even $50,000, convert that over to a Roth IRA, pay the 12% taxes now, and let that portion now grow tax-free for themselves or for their beneficiaries. And if you can do that for a couple of years, then you're able to build up a pretty nice size Roth IRA. And so when you do hit that RMD age, now you're able to kind of pick and choose. Okay, I've got to take something from my IRA, but do I want to supplement it with my Roth? So there's definitely a lot of planning there. But again, it's a case-by-case situation because there are some different gotchas where even if you're in a very low income bracket, it could affect your Social Securities. Conversions could affect IRMA, which is going to be the premiums you pay on Medicare. So a lot of things for us to go over with you one-on-one. And then again, the capital gains taxes, still 0, 15%, and 20%. That 0% is going to be for for under about $94,000, and then there's a pretty big range for the 15%. But this gets into a lot of planning, especially if we're working with individuals that may have NUA. That's net unrealized appreciation in their 401k. If you don't know what it is, give us a call. We can go through that with you. But this is a way to actually pay long-term capital gains versus ordinary income. And in some cases, it can save you tens of thousands of dollars in taxes depending upon your specific company plan or your situation. Now, another issue to be aware of is where are you living? You may not live in the same place when you retire. Let's say specifically, somebody living in, New York or California or Illinois, one of the higher income state income tax states, might have a desire to, hey, kids are grown. There's nothing really tying me here anymore. Maybe I'm gonna move from California to Texas. So instead of paying, close to 10% in state income taxes in retirement, I'm gonna pay 0 in Texas or Florida or someplace like that. So it's very important to understand this too. And that, that's an extreme example going from a high income bracket state to either no income in a state. But you also have to compare the difference of property taxes, state sales taxes, things like that. And we can go through that with you. But if you are thinking about moving, make sure you let us know, because we run a cash flow analysis, which is a detailed cash flow analysis or financial plan showing your retirement situation. We can run that side by side and show you, okay, what does it look like if I live in New York versus if I go down to Florida? And you can see the difference in how much that could potentially, save you or allow your nest egg to grow for your beneficiaries. So again, just be aware of this as well as you transition into retirement. Let's talk a little bit about some different IRA situations we run through countless times with our clients and our prospects. But we're going to talk about the rollover options, especially if you have a pension. A lot of companies we work with still have pensions, believe it or not. We'll talk about after-tax contribution to your 401k and how you can get that into a Roth. And we'll talk about that withdrawal strategy once you get into retirement. What are the pros and cons there, the kind of the old school method versus what we probably would suggest after digging into a detailed cash flow analysis with you. So most of you, hopefully on this call, have a 401k plan. You're making contributions to it. Hopefully you're in a company that does still provide some company match. Once you retire, you have the option, you have the option of just simply keeping that money in the 401k plan or rolling it over to an IRA. And there's different pros and cons there. Obviously, if you want to work with a retirement group, we would do that using an IRA. We clear through Charles Schwab. But if you like the 401k plan, you can stay there as well. But usually there's a lot more choices in an IRA and more help and guidance from firms like us as well. Now, if you also have a pension plan, it may be a classic plan where all you have is that pension, the monthly annuity you get, and that's okay. Some of the companies we do work with do also have a lump sum conversion option. So if you say, hey, I don't want to take this, let's say $4,000 a month for the rest of my life because I don't know what my longevity is like, or I want to make sure I can provide for my beneficiaries, or maybe I think I can grow it better myself, or I want more tax flexibility in planning. You might have a lump sum option. So you could also take that lump sum, roll it into your 401k, depending upon the plans, or roll it to the IRA. So a lot of times when we're working with individuals, if they do that, we're looking at both the 401k and the pension lump sum going into an IRA. That's not a distribution. It's simply going from one tax deferred account to another. So there's no taxes associated with that. But there are some different nuances to be aware of in that 401k plan. As fiduciaries, we're going to go through there, let you know if it does make sense to do that. I'll give you kind of a heads up. Let's say if you're retiring between 55 and 59 and a half, if you're talking with an advisor and they're telling you, let's say you're 56, and they're saying, hey, roll everything over to us, we want to help you manage it, they may not honestly be looking out for your best interest. There's a rule where if you turn 55 in the company plan, you're able to take distributions without that 10% penalty. So even if you had, let's say, $600,000 401k, want to roll it all over, we might say, well, okay, we can do that, but we might want to leave at least 100,000 behind or something like that in case you need to tap into it for something in the next couple of years before that 10% penalty goes away in the IRA at 59 and a half. So again, just to kind of food for thought, keep that in the back of your mind if you're retiring a little bit earlier. Now, one of the things we can actually help you out with while you're still working is looking at the potential spillover rollover into a Roth IRA. If you've got some after-tax money in there, maybe you've been, just decided you want to put in after tax because your plan allows you to take withdrawals. You're looking at it as a kind of a rainy day fund, or maybe you've hit the pre-tax limits and it's rolled over into after tax, whatever the case may be. If you've got after tax built up in there, what's going to happen is it's going to grow tax deferred in the 401k vehicle. So you're still going to pay tax on the growth, but that cost basis, depending upon your plan, it all depends upon the plans, the source specific distribution options. But some of the plans we work with, you're able to actually take that money out. And I'll give you an example in just a moment, but you're actually able to take that money out, the cost basis, roll it over to a Roth IRA, and the earnings rolled over to a rollover IRA. So again, there's no taxes on that transition, but now that after tax, excuse me, that's in that Roth IRA is going to grow tax-free versus tax deferred. So a lot of times this will happen when, we come across somebody who's about to retire. Maybe they've got a good chunk, $50,000, $100,000, even more in that after tax, we get that over. But it also works with individuals who are still working and maybe even haven't made contributions into the after tax. We can have a conversation of a way to essentially kind of load up on a Roth IRA in the coming years ahead. So let's take a look at an example for that. So let's look at somebody who maybe is 49 years old, so a year away from the catch-up options. They make $180,000. They've been making contributions the last couple of years. Let's say at 45, they bumped it up to 15%. So at 15%, that's about $27,000, which is above the contribution limits for this year, but also the contribution limits for the previous couple years. So what happens is, let's say in this company plan, for most company plans, if you max out your pre-tax contributions, they won't just stop it. They'll keep taking those distributions, but they'll roll over to after-tax. So in this case, let's assume this person has built up an after-tax balance in their source of about $40,000 over the last couple of years. But by rolling over, having that after-tax contribution come in, that 40,000 is not all cost basis. So what happens is, a lot of times, assuming we have earnings, which we've had over the last couple of years, and assuming there's growth, you put those after-tax contributions in there, and then they'll grow. But again, as I mentioned before, they'll grow tax deferred. Eventually, you'll pay taxes on them. So looking at it, if we did let's say this person had put in 26,000 over the course of the last couple of years, it grew to 40,000. They could leave that in there and let that continue to grow for the next, let's say, 5 to 10 years or 15 years, depending on how long they stay in that plan. But all that growth will be tax deferred, and eventually they'll pay taxes on it. The other option is we could actually take that, split it up, have that 26,000, again, if the plan allows, have that 26,000 go to a Roth IRA, and the growth, at 14,000 or so, go over to a rollover IRA. So that all grows tax deferred. I think we got a kind of a grid or example on the next page to kind of show you flow chart style. But ultimately, the issue is to review if this is something that's available to you. And we can also look at reviewing, what's the contribution schedule going forward? Does it make sense to still do everything pre-tax? Do you want to split it up, half pre-tax, half after tax? Is there a Roth 401k option within the 401k plan? Do you want to do that? Or would you rather put into the after tax so you can move that to a Roth IRA with more selections? There's a lot of different choices to go through there. So again, it's not just something to focus on if you're older or about to retire, but if you're younger and you're maxing out, or you want to build up a higher Roth IRA for tax-free growth, that's an option as well to review. So quick flow chart of this example. So let's assume that person had $650,000, about 40,000 of it was after tax, and about 610 pre-tax. We're not going to touch that pre-tax or the company match. That's going to stay the same. It's going to continue to grow, and you continue to make contributions there. But looking at 40,000 at this point in time, we can split that up. Again, the 26,000 cost basis to a Roth IRA, the 14,000 gains to a rollover IRA. So now that 26,000, let's assume it just grows at 6% rate of return for the next 10 years. That's going to be probably about $20,000 or so of growth, which would be tax-free. So it could save you a couple $1,000s in taxes. And if we kind of fast forward, do this year by year, if this person can still make those contributions, excuse me, then we can continue to grow that Roth IRA on the sideline. But again, they'll be turning 50 next year, so they have catch-up contributions, could do as high as about 30,500. So we'll have that conversation as well with them. Let's fast forward to somebody's retired and they're starting to take distributions from their account. When we run a cash flow analysis, the default mechanism on our tools, which you're going to see pretty much anywhere you go, is they want you to defer money or defer your taxes. The assumption is you don't want to pay taxes until you have to. So most of these plans will assume you tap into your taxable accounts first, like your bank accounts or brokerage accounts, things like that. Then tap into your tax deferred, and then tap into your tax exempt, like your municipals and your Roth IRAs. But take a look at kind of how that works out. You can see this chart. Let's assume that somebody, maybe they had $1 million, and maybe they had 100,000 in the bank and CDs or brokerage accounts. So in this case, in this example, they might plow through that for the first 2 years or so, and then they're looking at just tapping into their tax deferred, their IRA or 401k, and then maybe they're turning on Social Security. That's that yellow there, and if they have a Roth IRA, let it continue to grow, and then take that out towards the end. Now that's the classic method, but what happens is you're not really maximizing or planning for taxes appropriately, because those first couple of years you might be giving up some of the standard deduction options you have. We just mentioned it was close to 30,000 for a couple, so you might as well at least take out $30,000, which you're going to pay zero taxes on. Otherwise, this person is deferring that out to a later date when we do not know where tax brackets will be. So alternative will be, this is again just kind of a high level. We go through a cash flow analysis to get your specific details in play, but might be at a minimum, like I said, fill up the tax deferred buckets with that standard deduction, maybe more. Maybe we say, hey, 12% is a pretty good rate. Let's go and fill that up. And then if we want to kind of pick and choose, maybe take some from tax deferred, some from the bank if we need to, if we're managing those tax brackets. And again, the tax brackets change over time, administrations change, so we're going to manage those year by year. And you may look at a combination. The Social Security kicks in. Now you're taking some tax deferred, maybe some after tax. You still want to maybe defer that Roth IRA if you can. And then you start to determine, okay, I hit the RMD age. Maybe I want to take some from my Roth, some from my IRA. Tax brackets go up for a couple years, maybe take more from my Roth. So there's a lot of different ups and downs and options to do that. But generally speaking, just remember that you want to fill up your lower tax bracket buckets with tax deferred income. So your IRAs and 401ks. Beware of Social Security. So even if somebody's got a very low income, there's a catch-22 on here. You may not be paying any Social Security taxes, but if you take some withdrawals, that may increase your taxation on your Social Security. Not the taxation, but the amount that's taxed. So you may go from 0% tax to 50% of it taxed to even 85% of it taxed. So again, something to sit down with us and kind of review. And then just strategically utilize the differences between tax deferred and tax exempt portfolios year by year, because again, those tax codes change, the brackets will change, and we can manage those taxes with you. So again, it's not just about the investment management, it's also about managing those taxes and how much can you keep in there as well. So it all goes back to that cash flow analysis I mentioned before. Give us about it could be 5 to 10 minutes to gather some data from you. We can also email it to you if you want to take some time and get it back to us. Give us about a week to run a full report, and we can get that over to you. Let you know, are you on the right path to retire when you want to? Could you retire earlier? We won't shy away from telling you, hey, you need to work longer as well. But right now, about 3/4 of Americans over 50 don't have a plan. If you can just spend a little bit of time with us, we'll be happy to get that together for you. I usually call that first one the rough draft. You'll see how it looks. Then we can go through there and tweak it and make some updates and changes if you want to see alternative scenarios. So we hopefully covered a lot of content here, but want to kind of wrap up, and we'll get to some questions possibly. But again, to remind those of you who the retirement group is, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition to retirement. We work with a number of Fortune 500 companies. Our advisors have a deep understanding of those specific plans. So whether you have questions on the pension, the 401k, healthcare retiree, medical, insurance continuation, life insurance, things like that, and go through all those different questions for you. We do have offices throughout the country, so rest assured if you need to sit down with one of us face-to-face, we can likely accommodate you. But obviously this day and age, post-pandemic, it's pretty easy to have webinars, phone calls, email communication, whatever your preference is, just let us know. And then that cash flow analysis, the financial plan I mentioned before, that's complimentary. So go ahead and take us up on that to at least see where you stand. And that can help back into those other situations we talked about as far as, okay, should we review your 401k, the investment side of it? We didn't even talk about that today. But, what's the right contribution strategy? Should you keep doing pre-tax? Should you split it? Should you have some after tax, have some Roth 401k? Should you actually look at outside investment options? We can go through all those different options with you here. So with that, I think I spoke a little quickly to keep everybody, keep us to time. But, we got a couple QR codes up here I'll leave up when Sam comes back with some questions, hopefully. But one's to get into our LinkedIn. You can follow along with us there. And if you want to get into the company specific LinkedIn, we can get that over to you so you can get some company updates. And then if you want to schedule an appointment with myself or one of the other advisors in the office, you can get into our calendars here. And you can always reach at info@retirementgroup.com or call us at 800-900-5867. And I've got the disclaimer at the end, but I know Samantha's coming back on here. I think she may have mentioned before, but just a quick reminder, we do work extensively with a lot of companies. That does not mean we're endorsed by your company or employed by them, just so you know. But we do have extensive knowledge of those plans.
Thank you, Wesley, for that reminder. All right, we're gonna just do a couple questions in an effort to get everybody out, in a fashionable manner here. Wesley, what are the tax benefits of a traditional IRA versus a Roth IRA?
Okay, yeah, we went through this whole thing talking about Roth IRAs and rollover IRAs and Roth 401ks. Very simply put, let's go back to an IRA versus a Roth IRA. If you make a contribution into an IRA, it's typically going to be a pre-tax basis where you're going to, depending upon your different income level, you're going to get a tax deduction on that. So just like the 401k, let's say somebody's making $100,000, they put in 5%, they put that $5,000 in there. It looks like they only made $95,000 because they take that tax that tax deduction on there. But eventually they can pay tax on that full amount. Whereas a Roth IRA or a Roth 401k, they may still put that $5,000 in there, but they're not getting that tax break on it. So it's still going to look to the IRS like they made $100,000. But the better news is that Roth is going to grow tax-free. So that $5,000 you've already paid taxes on, it's tax-free, and then all the growth on that down the road, as long as you keep it there for at least 5 years and hit 59.5. There are a couple of rules there, but we can go through those with you.
Alrighty, thank you. Next one. What can I do to protect my IRA from inflation?
I will hopefully we're we're selling in, and we're hopefully behind that. We've seen kind of the Fed rates pause here for the last 6 months or so. But we did work with a lot of clients on this the last couple of years. We talked about inflation, but some different things to kind of be aware of. It depends upon your 401k, what choice you have. You may not have that many versus IRAs. There's more options, whether you want to look at TIPS, Treasury inflation protected securities, you look at commodities. We tend to focus a lot of times with the retirement group on value funds. So different companies that have that pay good dividends, meaning they've got cash on hand. They're not stuck borrowing when borrowing costs get higher. So again, a lot of times that yield will offset some of that inflation there as well. But again, it comes into just management. Another one that that a lot of people won't talk about, and we can't actually manage them, but you can look at I bonds and stuff as well. Those are good inflation hedges, but you have limits on what you can put in there each year. So again, the best thing is to give us a call, run through a review, and look at your personal situation, let you know what your 401k provides versus what you may have options in an IRA to help out pay some of that inflation.
Yes, there are definitely so many factors that it would be so advantageous to use those QR links, use the links in the chat, contact Wesley to talk to him about your specific situation. Okay, Wesley, one more.
Mhm.
When can I start withdrawing from my IRA without penalties?
Okay. So I had mentioned before that age 55 rule for 401ks. Keep that in the back of your mind. Again, we're going to talk to you about that if you're retiring before 59 and a half. But the general rule across the board is 59 and a half before you can start tapping into retirement accounts without that 10% penalty. So same situation with an IRA, 59 and a half. There are some differences where, if you're doing, some like first time home purchase, some medical expenses and things like that, where you can get away from it. The other option, we do work with clients that maybe retire earlier than 55. Let's say somebody retires at 53, you can do what's called a substantial and equal periodic payment. That's a Rule 72T in the IRS code. What that means is we can run a IRS calculation to determine how much you can take out a year without paying that 10% penalty. But you have to take that out for at least 5 years or until you turn 59 and a half. No changes. If you make a change, they can come back and retroactively penalize you. So if somebody was 53, they've got to take it out for 6.5 years. If somebody who is 56, let's say, has to take it out for 5 years. So it's really important to run that bias, because if you make a mistake there, it can come back and cost you as well.
Alrighty, Wesley, that was all we had time for. Any last closing thoughts before we go?
No, just a quick reminder again, a lot of these things are kind of high level, and if you want to dig into your personal situation, because everybody's unique and different, just give us a call. You can reach that 1-800-900-5867. Thank you very much, and we hope you guys have a great day.
Thank you, everybody. Thanks, Wesley.
Mhm.